Right, well, we welcome our guests now for further discussion on that mini-budget. Well, after several years of state-owned companies facing liquidity and solvency issues, the Finance Minister has highlighted that this trend of SOEs seeking bailouts to finance operational expenditure, inefficiency and waste must end. Of course, the most notable of these is Eskom. That has used 250 billion rand in government guarantees. A new board for Eskom expected before the end of November. Joining me now for our post-market and economic analysis is Kweku Koranteng, Senior Asset Consultant at APSA Consultants and Actuaries, Harry Plumstead, Cross-Asset Macro Strategist at Avior Capital Markets, and Martin Ackerman, Chief Economist and Advisory Partner at Citadel. Gentlemen, I want to start. There are a lot of interesting issues here, but I think the surprise today came from the announcement about using some of the Telkom shares to sell off to pay for state-owned enterprise debt, in particular SAA, one presumes. Now, that seemed to be off the table. It had been floated. There seemed to be an ideological objection in one way, and whatever the other reasons were, it appeared to have been moved away. Now it's back on the table, very much so.
Yeah, so for me, again, it was a bit of a surprise. I mean, it has been in the, media for the last couple of months. And I think some of the reasons why a lot of us would have been surprised at that is that Telkom at the moment appears to be an entity that's actually reasonably, well managed. You've seen its profitability and business functionality improving quite significantly over the last, couple of years. And in the last couple of years, with some of the losses and governance issues, SAA has had, and we're not too sure what the solutions will be to, solving that carrier's problems going forward. It does come as a little bit of a surprise.
Of course, wherever they find the money and put it in, you need someone who's going to manage the airline better. I mean, that's the point, isn't it? We've got a new chief executive who, for some reason, can't come from Vodacom immediately. You'd think Vodacom could find someone else to do the job, Harry. What's your reading of this, and what's the effect going to be on the investment prospects and on the market generally?
Ultimately, for foreign investors and actually local investors, this is saying, no, this kind of SOE support provided by the government is going to persist. Does South Africa really need a state-owned airline? I heard some very good points from one of your previous guests on the show saying, yeah, but there are benefits through tourism. This is a pit. I mean, one of our guys looked at the amount of money that's been spent on propping up SAA. You could have bought a 100% equity stake in a large global air carrier using that amount of money. So, I mean, we need an air force. Do we need a state-owned passenger airline? Probably not. You'd assume the private sector will step in and fill that gap and ultimately stop draining funds that we clearly need. I mean, there's a structural deficit here that we have to deal with. And that's pointing in one direction.
But at least they're not borrowing more or taxing more, we hope, to fund this. At least it's coming from, I mean, why does government have to own shares in listed companies anyway? They can raise money from tax.
Correct. I mean, if it's important systemically for periods of time following an economic contraction, for example, you can make a very strong case for that kind of state ownership. But if that isn't the case, if the economic environment globally is fairly benign, you'd expect the private sector to be able to handle those kind of entities. So yeah, we think certainly those assets should be sold off to the private sector. And me, myself, I'm actually quite left of centre politically. I still think that is the case and the state shouldn't be involved there.
Martin?
Yeah, I think, it's been on the table, and like you said, it's now back. I think there's a message behind this. So the government is painting themselves into a corner. So, the economy's not growing. We've got the big deficit, much bigger than everyone expected. So how do they get revenue? So they can tax more, but he actually also mentioned about a tax revolt. So, we're getting to the limit there. We're getting to the tipping point. Maybe some other taxes that we never spoke about before might be on the table 2018. We can definitely borrow more, but the rating agencies is already looking at us and saying maybe not. But interesting there, debt to GDP, for the first time ever, is now going from 50% to 60% at the end of this framework. So he's definitely planning that they're probably going to borrow more, whether that is going to be to support state-owned enterprises, maybe some of it.
Where's the alarm bell? Where does the alarm bell ring on that ratio, that 60%? Where does it get to where you say, no, we can't go further than this?
It's different for every country. You know, for developed markets, if you think about the US, if you only look at government debt, they're already at 100% of GDP. They sit with the reserve currency in the world, so people are much more willing for them to sit at those levels because they know they will get payment down the line. For emerging markets more generally, I think it's probably
to find revenue from somewhere. Kweku, what are the other things that stick out for you from this mini budget, as it's called?
What sticks out to me is that it appears as if there aren't, you know, clear plans to address the economic growth and some of the issues that, you know, lead to where South Africa finds itself. I was also surprised that, you know, the size of the deficit. I mean, the market was estimating anything between 25 to, you know, 50 billion, and it was just on top of, you know, that 50 billion. So it is pretty much on the high end. And my concern is that even though they've projected, you know, the debt to GDP to be just over 60% a couple of years out, if you look at countries like Brazil and even what happens with contingent liabilities, etc.
It's a bit like, you know, if it was a listed company, it would have had to put out a SENS statement warning that the earnings were much worse or better, in this case worse.
I just want to make one point on what stuck out for me. The delta between estimates in the budget review in January and this medium-term budget speech.
Explain the term delta?
The change. I mean, we've spoken about the debt to GDP forecasts moving higher. I mean, that was significant. Some of the other estimates are unbelievably optimistic. If you look at what they are forecasting for gross fixed capital formation, for example, so just aggregate investment, that in 2016 was about negative 3.9%, last year about negative 0.6%. They're saying 2018 we get I think 0.5%, and that jumps up in 2019 to 3% gross fixed capital formation growth.
And you're saying, why should it?
No, it's we've missed our chance. End of 2016 and throughout this year, the global macro environment has actually been supportive of emerging markets. It's been robust growth in Europe, in the US, with central banks not tightening too rapidly. China's been outperforming economically. We think China next year might slow, so decline a little bit more rapidly. So that's a worry, but we've really missed our chance, and these numbers are still deteriorating as we go on.
So, Martin, can we trust the numbers is another way of putting this question. I mean, I'm always struck with the Reserve Bank and the Treasury. When they look at growth next year, it's always more than this year. And the year after that, it's always more than that. Not necessarily a rational projection.
I think it's human nature. It's not whether it's the Reserve Bank.
Being optimistic.
You know, it's the IMF, they do the same. So I think the numbers in terms of the high-level numbers like GDP is quite realistic. I think it's very tough for Minister Gigaba to stand up and say, listen, this is the situation. So, you know, we couldn't get away from it. And maybe it's not about the numbers going forward, but it's been the deterioration since February, which is, you know, a couple of months ago. And that's why I'm very concerned that, you know, we haven't done anything actually to improve the situation to next February. So the numbers actually warrant a downgrade. And the question is not if, but when. And we're also in a very unstable political environment up until December. So we're in a danger zone. So I think the numbers are true in where we are currently. You know, they see GDP grow, for example, because that's the bottom line. If we can fix growth, we fix all the other stuff. And I do think, I agree with Harry that the fixed investment is negative right now, and then they see it going positive. And that's only built on what he said, that, you know, the cheapest way of stimulation is to restore confidence, which is right. So if we can restore confidence, maybe the debate should be, how do you do that? Because if we can do that, confidence will follow first, and then the rest will follow. So if we can do that, yes, we might get some new capital formation in the economy, but including that, yes, they see growth at the end of the framework, so in 3 years' time at 1.9. It's not even 2%. So, you know, we spoke about this last time as well. That's close to the growth in population. So we're not actually moving forward. We need growth 3.5% to 4% to actually fix the structural issues.
And you talk about confidence as the quickest stimulant, and of course that comes back to the political situation. So we're in a vicious circle here. Kweku, the rand, I gather it's just gone through 14, and it's weakened by 30 cents or more from in the last 24 hours. And certainly this afternoon there was a big 3.5%, I think, weakening there. So on the rand.
So the risks to the rand over the next, couple of months is actually to the downside. I mean, you have some political developments, that will be unfolding. There's the spectra of, credit rating downgrades, and then all the, economic risks that sit within the economy. On a valuation basis, I mean, for a while, the rand has been considered to be, undervalued, but given, the general sentiment and also what's potentially developing in the US and other developed economies, the risks continue to be on the downside.
Martin?
I fully agree. I think we look at a number of indicators. Most of them actually point to a fair valuation. Now, they can't see political risk, so they look at exports and reserves and those kind of things. And then there's a couple of them that actually point to quite significant depreciation over the next couple of months. There's no one of those actually pointing to appreciation. So I agree that there's a couple of things locally, but we also know that the rand is much more sensitive to global factors. Now, if you look at the Fed, there's now almost an 80% probability that they will hike in December. The dollar will react positively on that. So if you look at that mix together in terms of international factors, what's happening in China, and then all the hurdles that we are facing, I think the rand is definitely positioned for some more weakness going forward.
Harry?
Yeah, I mean, year to date, or at least year to August, I would have disagreed with you guys. I would have said this is an opportunity to buy rand, or at least long rand exposure in SA sovereign debt, financials, SA property retailers. Now I completely agree. The proximity to the end of the elective conference, it's too close. I agree that the Fed's going to hike again in December. It's only about 80% priced in, so some more upside for the dollar there. They're starting that balance sheet runoff, which we don't think is going to have a material impact on markets, but you still might see some pull on the dollar from the beginning of that process. And as we say, credit extension in China, we think it's going to slow following this most recent Communist Party conference. So all new headwinds for the rand. And yeah, no, I agree.
Let's see who wants to pick up this one. I think people weren't expecting a wonderful mini budget today. I mean, the expectations were low.
Tough, yeah.
So on the one hand, it's the way he handled himself. It's the way he dealt with his first big test of this is how we're going to walk the talk. And on the other hand, it's the numbers, as you say. So what was it that hit the rand today? Was it the way he did things? Was it that the numbers were worse than we thought? Is that the key?
I think it's the numbers. If you think about it, he said exactly the right things in terms of what we need to do or what we need to inspire to do in terms of more inclusive growth, creating jobs, all those kind of things.
But they always say that.
They always say that, yeah. So what's missing, and you've referred to it earlier on, is that no real plans to say, but this is what we're going to do in the next 6 months. In fact, just kicking the can down the road to say there will be more on this in the February budget. When they spoke about increase in revenue, also just said there will be more on that in the February budget. So I think the numbers, the fact, the rand actually started to slip before he started talking. And I think it's all about the fact that the numbers, or actually you mentioned the delta or the change, the deterioration since February. That was the reason why the currency reacted that way. Remember, the currency is like a share price for a company. So suddenly we've got a company reporting, like you said, there's a sense announcement and it's bad for the market, share price goes down. That's exactly what the currency told us today.
Yeah.
I mean, he's only been in the job, for a couple of months, and I have to admit that, in the last 20 years, this is arguably the most difficult medium-term budget speech. He was fairly honest. He was open around the problems facing the country.
Worse than the global financial crisis?
Yeah, well, probably
had more of a surplus in the years before that.
But we find ourselves in a situation where the rest of the world is experiencing synchronized, economic growth, and we've literally decoupled, from that in the last, couple of years, and that's the challenge that we face.
Yes, you mentioned the global financial crisis. Up until that point, we had benefited from the peak of the commodity super cycle. Now, that kind of model that you would have used as an EM to export your way to higher welfare, it appears to be dead. So we don't have that incremental growth being driven from any of the large economies now. China is slowing. The US is not going to provide that extra demand for the commodities that we are exporting. So if you were hoping as an EM to go that route, you've got to look elsewhere. You've got to look to innovation, and you've got to look to freeing the markets, making yourself more competitive. You can't just rely on commodities to increase GDP per capita.
Martin, how might investors react to this if it's worse than they thought? What kind of behavior can we expect here, not just on the rand, but what kinds of investments?
Well, I think, if you think about the next couple of months and the likely further downgrade. So I would say, probably be underweight bonds. The bond market is probably going to get hurt in that kind of event. You'll probably do better just sitting in cash at this point in time where there's no risk. Even at the current level of 14, I still think it's a good time to externalize more offshore if you're in that position. So global investments in this kind of situation, we spoke about the global economy that's doing quite well and synchronizing, and more support there. The JSE is an interesting thing because the JSE is two-sided story. So Rand weakens, Rand hedges do well. There's some return of confidence, the local companies do well. So the JSE, I'm not too worried about. There's certain sectors, like we saw the banks today as well, that took a bit of a knock. So I think it's more the currency and the fixed income markets where there's potential.
But you used the word decoupling a moment ago, and of course the JSE to a large extent now is decoupled from the South African economy.
Exactly.
The most dominant companies are about global operations, not South Africa. If we were to isolate the South African companies, it looks rather different.
We think about 60% of earnings on the JSE comes from offshore. So clearly it's not a very indicative, it's not indicative of, the reality on the ground. For that, you're going to look at the Rand, you're going to look at fixed income. So certainly, I was on last week, we think the JSE can still make more highs, just given the global environment. The Rand, it's not an obstacle.
Well, Telkom was, I think, the surprise of this speech amidst all the data. Yes, it was worse than we thought, but we knew it was bad, whereas the Telkom thing seemed to be off the table. So what are the kinds of things now that the market will look for? Because they've announced it, but when's it going to happen? That's one thing. Are we going to see urgency and action here, or is it going to take a long time? As you said, some things kick down the road to February, which means that if they announce something, it'll only happen in June, or filter through the following year, and we're into 2019, 2020. What would the market respond to, given where we are now today, Kweku? What do they want to see? Something dramatic.
What markets want to see would be, more reassuring measures that address a lot of the, issues that we currently have. But, when it relates to Telkom, I think the market is generally of the view that you can't, sell the good to, fix the not so good. But that's where the government finds itself, and the type of strain that SAA is taking at the moment. If I had to hazard a guess, it would have to be quite soon, because some of these deadlines are looming in terms of the debt repayments.
Well, if the new man comes in, he's due to take office shortly. You've got to give him a couple of months to get his feet under the table and find out what's going on. So but you'd want at the end of that time some signal that something's going to happen at SAA.
We need to see improvement by February, definitely. And I always say that, and you also mentioned that state-owned enterprises shouldn't be run by government, and the reason for that is actually simple. It's nothing about the government or the people. It is about the fact that there's no profit incentive. The minute it is in a private company, there's a profit incentive. So that's what's driving it. So you can't really point to a person or an industry. It is whether you're in for it to make a profit or not.
Well, and look at Come, and they've been making a profit every year since 1949, I think. And the conditions are the same, and the diesel high-octane fuel goes up or down for everyone. Harry, what about Eskom? We haven't talked about that. And if SAA is a risk, Eskom has the potential to pull the whole country down with it.
Yeah, so the contingent liabilities there are big. It's not a big focus of mine, but I do see some difficulty on their part in raising debt over the next 3 years. Certainly, it's not the case that they're not going to be able to fund operations, but they're just incrementally going to be paying more for that debt, and that obviously puts the onus on government down the line, which is a problem, and it's not going to be looked at in a positive light by foreign investors in particular.
Quick final point from you quickly, and then we'll go to Martin.
It'll be interesting to see, the real numbers in February, just regarding how we address our fiscal challenges. But I think South Africans should, brace themselves for a fairly challenging 6 month to, a 1 year period, whether it's in the form of increased taxes, whether it's VAT or personal income taxes or excise duties, etc. I foresee that, coming in February next year.
And already business confidence and consumer confidence are not at good levels.
All time lows. I think maybe just on a positive side, the global economy is doing well, and probably for the next 12 months the global economy will keep on doing well. So we shouldn't underestimate the fact that if we can turn confidence for whatever reason, maybe it's just some stability over December, and maybe some better numbers in February, that we can actually get to a much better point much quicker than what we expect at this point in time. But we need to turn that 1 degree to actually get there.
So maybe psychologically it wasn't a bad thing to get the bad news out now. That's Kweku Koranteng. He's Senior Asset Consultant at ABSA Consultants and Actuaries. We've been talking to Harry Plumstead, Cross-Asset Macro Strategist at Avior Capital Markets. And you just heard Martin Ackerman, Chief Economist and Advisory Partner at Citadel.